Hey everyone, welcome back to the channel. I'm Doug, the retirement guy with the monthly ETFs. And today we're taking a look at 5 monthly ETFs that have shown more stable NAV behavior based on the historical charts from the last 1 to 3 years than other funds out there. Because we think December is always the time when we're going to rebalance our portfolios, and these are 5 funds that I think everyone needs to look at when they're looking at possibly rebalancing. Now, this is strictly educational, no financial advice, no promises, no recommendations. So what we'll do is we'll walk through why the NAV stability matters, what criteria I used, and then we're going to rank them of the top 5. Let's get into today's video. Quick reminder though, before we start, past performance does not guarantee future results, and everything in this video is for educational and informational purposes only and should not be considered financial or investment advice. These examples are illustrative and they may not be suitable for all situations. Please consult a licensed financial professional before making financial decisions. Why NAV stability matters for income ETFs? When people shop for income ETFs, yield usually gets the spotlight. But NAV stability matters because it can impact long-term investment health. The steadier the NAV can support a more balanced strategy, improve market resilience, and help the capital preservation, and potentially make income strategies feel more sustainable over time. Today's list focuses on the NAV behavior, not maximizing your yield. So here's the 4 criteria used for making this list. First, historical NAV data. Each fund has multiple years of publicly available NAV history. Second, non-leveraged strategies. No leverage, which helps avoid magnifying ups and downs. And third, reputable issues managed by established firms with robust oversight. And the fourth, steady NAV patterns. These show more consistent NAV trends compared to higher yield alternatives. So again, we're not looking for the massive, the biggest yield I can get. We're really looking at what I'm concerned is total returns and what is the NAV done with the portfolio. So let's start off with number 5. It's the Global X S&P 500 Covered Call and Growth ETF, XYLG. Now, this fund here it's unique because of its strategy. It sells covered calls on only 50% of the portfolio. So you get a hybrid approach. Half of the fund has room for participation in the S&P 500 growth, and the other half is focused on generating option premium income. Now, historically, the 50% overwrite approach can reduce the pressure on NAV compared to a fully overwritten cover call funds. Now, the quick snapshot of XYLG's historical breakdown that we show, you will see a mix of income, growth, and overall total return from the period analyzed. Important note, the numbers like yield and return can change over time, so it's not a forecast. The main takeaway is simply an XYLG structure. The covered calls on half has historically aligned with a smoother NAV pattern of 100% covered call approach. You can see even with the April 2nd and the November market adjustments, we are still over 6% growth in the fund year to date. When you look at the performance chart, you can see year to date, 1 year, 5 year, and since inception, everything's well over 10+%. At number 4, we stay in the Global X family, and that is the NASDAQ 100 Covered Call Growth and ETF, XYLG. Now, XYLG targets the NASDAQ 100, which is typically more tech-heavy and can be more volatile. But like XYLG, QYLG covers only 50% of the portfolio with covered calls. This means part of the portfolio can participate in NASDAQ's upside while the other half generates the potential income. Historically, the partial overwrite can create less NAV drag compared to covered call products like QYLD. So this fund, again, you can see year to date, it's over 6% growth even with the November and the April adjustments. And when we look at the performance of QYLG, again, you see it well over a balanced approach, over 10% year to date, 1 year, 5 years, and it's since inception. So the two funds that we just showed you, XYLG and QYLG from Global X, are using the similar strategies with just using different underlines. One's going to be the NASDAQ 100 and the other one's going to be the S&P 500. Number 3, we get into the NEOS S&P 500 High Income ETF, SPYI. Now, SPYI takes a flexible approach than the traditional covered call fund. It combines call options with put spreads, aiming for a balancing the risk management while harvesting premium incomes. It also emphasizes on tax optimization in how the structure is positioned. Historically, what stands out that SPYI has shown a surprising consistent NAV trend and often been more closely aligned with the broader S&P 500 than many pure covered call funds. When we look at this fund, using the April and the NAV adjustments, you're looking at year to date of 3.76%. When we look at the performance data that's come out, year to date, the 1 year, and the inception is well over 12% across the board. So you can see again that the performance over time and the year to date have been above the market analysis. At number 2, we have the JP Morgan, and this will be JEPQ, the JP Morgan NASDAQ Equity Premium Income ETF. Now, the fund is a major player in the NASDAQ income space, but it's not built around extreme yield targets. It uses equity-linked notes and a premium income framework designed to enhance income while maintaining a more controlled risk profile. Historically, JEPQ has shown less NAV fluctuation than many NASDAQ income competitors, with smoother long-term behavior around the broader NASDAQ trend. The balance is why it's ranked at number 2 for the NAV stability in the list. We look at the chart, 3.19%, everything 14, 12, and 16% since inception. This fund gives you a total of about a 12% across the board return. Now, we know numbers will always change, and these numbers can change at all times. But JEPQ is one of those funds that just keeps producing and producing. And our number 1 fund, JEPI. Now, JPI is widely known for a more conservative premium income approach. It holds a diversified large cap portfolio and uses synthetic and a systematic non-leverage option strategy. Historically, it has contributed to the lower volatility and smoother NAV curve compared to many income ETFs. We show you on this that JEPI, reference to the NAV stability compared visually, again, it is based on historical behavior from periods reviewed, not promising of future results. When you look at the NAV stability in our upper right-hand corner, you will see JEPI in the dark green line has been fairly smooth. When you compare to what JEPQ and SPYI has been, you see a wide range of belts going up and down across the board. Now, JEPI, yes, has not had as much growth. It's at 0.35 with the big changeover in April and also in November. But when you look at the performance over this thing of the past 1, 5 years, you see that the fund is really at the lowest point of 5% return up to 11% return. So again, you're trading off stability for some of the growth. So if you're looking for something more stable versus always big growth, this is where JEPI comes in the ball game. So in summary, the top 5 ETFs that we put into strictly on NAV performance, NAV behavior. Number 1, JEPI. It's the broad market premium income for conservativity, diversified approach, and historically one of the smoothest NAV curves in the category. JEPQ is the NASDAQ premium income using equity-linked notes, historically showing moderate volatility from the NASDAQ-focused income. SPYI gives you the flexibility, the S&P 500 option strategy using calls and puts with that tax-aware structure. And it's had a steady NAV trend. Number 4, QYLG, it's the NASDAQ 100 with that 50-50 blend, that hybrid setup, 50% covered call overwrite, while the other side is participating in the full overwrite of the fund. And then XYLG is the S&P 500 version that exposes that 50% overwrite concept, giving you that balanced growth and income approach. Now, our key takeaways and final reminders. These rankings are based purely on historic NAV behavior observed in publicly available charts over the past 1 to 3 years. This video is really for educational purposes and is not financial advice. It's giving you something to look at. If you have issues and you've had some tough times this year, here's 5 funds to help you balance your portfolio. So if you want deeper dives, like comparison charts, total return, breakdowns, or a full breakdown of any one of these funds, leave a comment below and tell me which funds you'd like to see, and we'd be more than happy to help do our own research and help you with your research down the road. I want to say thank you for your support, and don't be afraid. Hit that comment, hit that subscribe button, hit that bell notification. Hopefully this video helped you out as it helped us out.
Thank you for watching. Press the like button, hit the subscribe button, and join. Leave any comments